Good morning, everybody. Welcome to my YouTube page. I'm Mark. I'm the stock market jobber. I'm a former institutional trader. I traded at two of the best funds probably in the history of Wall Street, actually, Steve Cohen and Mario Gabelli. I traded directly for each of those two. I was also the head of trading at three different money managers where I oversaw various trading styles. I spent some time as a market maker. So when it comes to trading, there really isn't too much I haven't seen. So now I want to teach people like yourself about how the markets really work and what institutional traders really do and what really goes on at these big mysterious hedge funds. And believe it or not, some of them are not as mysterious as you would think. But that's another discussion for a different time. So here's our S&P 500. Okay, this is what people call the SPY or the spider. It's because it's put out by the S&P 500. It's a Standard and Poor's Depository Receipt. It's an ETF that is designed to follow the S&P 500. It's 1/10 of the value. So this is where we kind of start off our analysis. This is the most important benchmark. But this benchmark is made up of 11 different sectors, and sometimes if we look at the sectors, we can get an idea as to which way this is going to go and which way, if this is going to come back or if it's going to keep going. Now, my suspicion is it's going to keep going lower. And I think we're probably going to get some support around 390. Now, in the institutional world, we don't worry about silly things like Elliott wave and Fibonacci. We worry about what price levels are important, what trends are important, what's the momentum, and what is the market psychology. And every chart shows market psychology. And we could see that here. Notice how this support level mysteriously turned into resistance. Well, this happens because of buyer's remorse, which is psychological. There are people who bought here who regret doing so when the price dropped, and they tell themselves, I want to get out, but I'm only going to do so if I can get out at break even. So they place their sell orders at the same place they have their buy order. And if there's enough of them, the level that was support converts into resistance. Here we see resistance somehow mysteriously converts back into support. This happens because of seller's remorse. It's the opposite. People sell, the price goes higher. A lot of these investors say, I made a mistake. I'm going to buy my shares back, but I'm only going to do so if I get them for the same price that I sold at. So if you have enough remorseful sellers placing buy orders at their selling price, the level goes from resistance to support. Buyer's remorse can turn support into resistance. Seller's remorse can turn resistance into support. So one of the things you need to know if you want to be a successful trader is which price levels are important. For some reason, certain price levels have more importance than others. And sometimes we know why. Like if something gets to say, like Tesla stalled out at the $200 level for a few days last week. Well, it's because people like nice round levels. So they say, all right, well, if it gets to 200, I'll sell. No one really says if it gets to 197, I'll sell, or if it gets to 201, I'll sell. People say if it gets to 200, I'll sell. So that's a psychological level. But here, why is 390 important all through here? Well, we know why, because it was important support back here. But back here, we don't know why it was support. Just for some reason, that's where the buyers decided to step in. So we see resistance here, resistance here. We looked like we were going to get through the resistance, but now we're making a turn, and we had a pretty nasty day on Thursday, and we had really no recovery at all on Friday. So the tide may have turned here. This Notice how here resistance became support for a few days. So this trend could be changing. If you think about a trend line, you can see that. Well, think about it this way. Now that it's Super Bowl Sunday, so pretend the blue team is pushing the ball up the field here, and the red team makes a goal line stance, and they turn things around. See, like we got a trend there, trend there. Markets are always trending. That's the only guarantee on Wall Street. And one of the ideas is to try to understand where the trend is changing because that's when you can make your money, right? And those trend changes usually come at important levels. Now let's dissect this a little bit more. And this is what I'm going to be focusing on this week to see which way this goes. Now here are the 11 sectors I mentioned. The S&P has 11 sectors, and at different times, different ones are in the driver's seat. Different things drive the market at different times. So the most easy put let me just give you a hypothetical example. It's never going to be this easy, but just pretend all these sectors are completely flat and they haven't moved in a week and consumer discretionary is skyrocketing. Well, The S&P is just the aggregate of all of these. So if one of these is moving higher, then the S&P is going to go higher. But if that particular sector that's driving the market, say it gets to resistance and it gets really overbought and it looks like it's going to roll over and come back in, well, that tells us that the S&P looks weak and there's a chance that it could come lower. So we need to look at the parts of the puzzle to figure out what's going on with the puzzle. Or I guess we need to look at the parts of the S&P to see if we can figure out what's going on with the S&P. Now, financials have been a primary driver of the recent rally. All right. Now, we could have the old false breakout here. See, resistance, resistance. And it looked like it was going to get over, but this is a pretty decent looking reversal pattern here. The blue team is in charge, right? Super Bowl Sunday. Blue team's bringing the ball up the field. The red team makes a stand and converts or makes a stand on fourth down and takes over the trend. Now, notice how on Friday we got back up here and we stalled out right at this important level, which was the resistance back here and resistance here. So after a big move lower, it's not unusual for something to have a little bit of a rebound. If XLF, then this is the ETF that tracks the financial sector. If this can't get back above this 3650 level, that's probably going to result in the market or this sector of the market trending lower, which would obviously not be good for S&P. So I'm going to be watching what the action is here in XLF. This is our consumer discretionary sector. Resistance became support on Friday, right? See, we had this nasty reversal up here. That's a clear indication that the red team has taken over. Now, if this level here doesn't convert to support and it starts to break down, that's going to give me another signal that the market could go lower. So we looked at financials, which could be forming a downtrend, and we looked here at consumer discretionary to see if this level here converts into support. Remember, it's seller's remorse. People who sold, a lot of them regret doing so when the price goes higher and they tell themselves they're going to buy their shares back, but only if they can get them for the same price they sold them at. So these remorseful sellers, if there's enough of them placing buy orders, well, that'll form support. But if not, that's going to be negative for the broad market, and by that I mean the S&P 500. Here's healthcare. This is our second biggest sector, and we can see we're just in a downtrend here. We got back below this important 134 level. Now, where could this get down to? I would look here. When you're looking for where a trend might change or where to have your price target or your buy target, look into the past and see where there were former peaks and valleys or former failures at resistance or support. So remember, there are people who sold here at this top here who regret doing so now that the price is higher. So there's going to be a lot of them are going to try to buy their shares back. So there's probably going to be some support around 128. We could see down here the 120 level was support. So sometimes an important level can stay support or stay resistance for a long time. Sometimes they shift back and forth. Sometimes they don't. This is what we call market memory, or just the concept of markets running into important action at former levels that were important. That's what we call market action. Um, all right, yeah. So knowing where the levels are is like having a map, right, to the market. And if you don't have your map and you're in a town where you've never been before and you don't have your GPS, you're not going to be able to get around. Personally, I don't think that you can be a good trader. I'm not saying investor, but trader, day trader, swing trader, which is what most of our students are, and most of them are options traders, without understanding this concept of how some price levels are more important than others. And I mean, like, look, you don't need to be a market guru or a hedge fund trader to see that. Oh, gee, this 1134 level is important. Oh, gee, this 120 level is important. So that's something else I'm going to be watching. Same kind of thing here with the technology sector as we saw with consumer discretionary. Will this resistance level turn into support? And we can see here resistance turned into support. If this starts to give way, if financials start to form a downtrend, if consumer discretionary breaks that support, and if healthcare trends lower, there's going to take the S&P lower. I think there's a good chance that it does, and I will show you why. This is the psychology of the market. This is from the American Association of Individual Investors. They asked their members, are you bullish, bearish, or neutral? So we could see bullish is up to a 1 year high. So a lot of investors have become really bullish over the last week or two. And for reasons I don't understand why, because it's pretty clear to me that the Fed is not planning on cutting rates anytime soon. But you might say, well, gee, Mark, why is having a lot of bullishness bad for the market? And here's the answer. If the vast majority of investors are bullish, what do? They invest their funds. When they stop and they're out of money, there's no one left to push the market higher. So excessive bullishness, and this isn't excessive, but it's worth paying attention to. Excessive bullishness is bad for the market, and excessive bearishness is good for the market. If the vast majority of investors are bearish, what have they done? Well, they've probably sold their stocks. And then the market runs out of sellers, and the only place it can go is higher at that point. So we got some what could be weak technical action, and we got what could be some bearish psychology here. So that's it, everybody. Thank you so much. Hope you have a nice week. Please check out our website. Please subscribe here to stockmarketjobber.com, and I will talk to you soon. Thanks, everybody.